What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to cover some other notable names on the market, such as Tesla, Apple, Amazon, AMD, Nvidia, and Meta. We're going to talk about some things that happened last week and some things that are happening this week that could potentially push markets higher or lower, and we're going to talk about all the resistance and support points that we need to focus on for all the stocks we just mentioned. So let's go ahead and get started by first talking about SPY, and we're going to do so on the daily candles. Remember, we always like to start with the macro picture, and then we move into the micro picture, which are the shorter term candles, to focus on what's going to happen throughout the week. But on the macro picture, which is the daily time frame in this case, we can see that SPY last week broke below two significant supports to start off the year. And before we jump into those supports, let's talk about some things that happened last week that made us break those supports. First things first, to start off the year, Apple, which is the company's or the world's most valuable company, received a stock downgrade from Barclays. So this was completely unexpected. They did downgrade the stock, noting that they see sales declining throughout the year, and therefore this caused a rude awakening throughout the market. And of course, Apple being the most valuable company in the world and the most prominent technology company in the world, when that company receives a downgrade, obviously it causes an entire market downturn. Apple's downturn was extremely severe. It moved below the 50-day moving average, and we'll talk about it and its specific targets in just a little bit. But before we jump into Apple, let's jump back into SPY and talk about those supports that we broke. The two supports that we broke are going to be the 10 and 20-day moving averages. When we pull up our charts, we always have the 10, 20, 50, 100, and 200-day moving averages. All these moving averages are used by institutional traders, including Wall Street, to gauge whether a stock is in a bullish or a bearish trend. For Apple, it fell below the 50-day moving average, which is Wall Street's favorite gauge of bullish versus bearish trend. So now that it's trading below the 50-day moving average, Wall Street is expecting the stock to continue coming down, just like the way when it broke above that 50-day moving average, which is this yellow line, it continued rallying higher. So for SPY, we are below the 10 and the 20-day moving averages. The next available support we have for us, or strong support on the macro chart, is going to be that 50-day moving average. But of course, we do have some supports to focus on before we get to that level. Now, if you are looking at SPY and you're looking at it on the daily time frame, of course, the first thing you want to do every single day, every single morning, is see where that daily candle opened in relation to the 10 and 20-day moving averages. As long as it is below those lines, then there is selling pressure and we are expected to head lower. If it recovers above those lines, then buyers can get comfortable again and potentially buy us up. Now, this is as far as the daily time frame goes. When we zoom in a little bit closer, if you are looking to day trade or swing trade within the week, there are some other levels to focus on, but just remember that you always want to keep the macro picture in mind before you look at the micro picture. The macro picture currently is spelling some trouble, so make sure you keep that in the back of your head anytime you're taking trades. Now on the micro picture for SPY, we can see that SPY here is below the key 470.40 support, but it hasn't entered a very critical level just yet. We are expecting SPY selling action to continue rising if it breaks below 463.50. Keep in mind that we sold off for the entire first week of the year, so there could be a relief bounce coming, especially ahead of the CPI and the PPI reports. Speaking of which, this week we are expecting some inflation updates. We are expecting the CPI and PPI reports to be released on Thursday and Friday. Now, last week, part of the reason that we came down, especially on Friday, there was a lot of uncertainty, was because the unemployment report or the labor market report showed that employment actually rose in December. You can see that from October, November, and December, hiring was going up. So while that is a good thing, generally speaking, for our economy, hiring going up is a good thing. The Federal Reserve is very critical of whenever hiring is going up, especially during a time of inflation. So remember, the Federal Reserve has been fighting inflation tooth and nail for the last 2 years. And going into 2024, they want to stay in control of inflation. So when hiring starts to go up, and wage growth starts to go up as well, which is something that this report reflected, then the Federal Reserve is afraid that what will happen is that inflation will just kick right back into gear and it will continue going up, which is why the expectations of a Federal Reserve rate cut actually fell from 73% to 62% following the unemployment report. So investors and markets were expecting that the Federal Reserve will cut rates in March. They had a 73% expectation to do so. But then the report was released. They saw that hiring was increasing. They saw that wage growth was increasing, which could lead to more spending, which could lead to higher inflation. Therefore, they lowered their outlook for a rate cut. 62% is still a pretty significant number, but nonetheless, that caused a little bit of uncertainty in the market. So coming into this week, with that in mind and with that uncertainty in mind, of course, the biggest focus is going to be the inflation report. These reports must come in line or better than expectations in order to satisfy the markets and to avoid a meltdown. Last month, the reading came in at 3.1% without energy or food. So with energy and food, we came in at 4%, but without them, we came in at 3.1%. The market needs to see 3.1% or lower on this report in order for them to avoid completely selling off. Remember, that's coming on Thursday or Friday. So Monday through Wednesday, we might see consolidation, sideways movement, or even a little bit of a bounce. Apart from inflation, and this is the last economic focus we'll talk about before we jump into our charts, we have some big earnings this week. The country's biggest banks will be reporting earnings from Bank of America, JP Morgan, Wells Fargo, and Citigroup. This is the first report of 2024. Banks always kick off earnings season, and of course, we are watching this closely. Last year, we saw multiple major bank failures that caused heightened uncertainty in the market, so investors will be watching these earnings very, very closely. So now we've talked about all the economic headlines that are going to drive markets up and down this week. Now let's jump back into our charts and focus on the levels. So we've already mentioned that SPY is below its 10 and 20-day moving averages. And of course, the 50-day moving average, if you're using moving averages, is still a very long ways away. So let's talk about some supports and resistance points that are ahead of that point. First things first, if you are looking for any kind of bounce on the market this week or on SPY in specific, you need a breakout above 470.40, but we do not expect buyers to get fully comfortable again until SPY is back above 477.65. Notice, usually we always have this whole section in green, but just given the uncertainty in the market, we are keeping this small section in green because we don't expect a full-on breakout unless we break above 477.65. These arrows are kind of a guideline of what we expect to happen. We're either going to get rejected at 470.40 and not break above this trend line, or we get above that level and we try to bounce a little bit higher until the CPI and the PPI reports on Friday. To the downside, we have a support placed at 463.50 on SPY. If we break below this level, you'll notice that this move was nearly vertical on SPY. Therefore, if we break below 463.50, there is not much support and we will likely free fall towards that 457 mark. So be very careful if we break below 463.50. If that happens, it will take the entire market down with it. Now, the next stock on our watch list is going to be Tesla. Tesla tried very, very hard to break out in the last few weeks, but you can see that it got rejected right above this breakout point and it got sold off tremendously. It is trading right above its 50-day moving average. This is a point in which Tesla spent weeks trying to get above, so the fact that it's back at it is not a very good sign. One other thing we'll notice about this chart, and we'll talk about this in all the charts that we're about to cover, is that the RSI, or the Relative Strength Index, is reading right around 43. Remember, when we're talking about the RSI, it measures relative strength. And so on a downside move, the closer that move is to 30, the stronger that downside move is. Now notice Tesla is not trading below this low on the chart, yet its RSI is way ahead of that low when it tested it. That means this downside movement on Tesla is extremely strong and you should treat it with caution. Here are some levels to focus on for Tesla if you are looking at the shorter term time frame. First things first, we have a resistance point at 242.80. This is not going to be enough to move the needle. In fact, buyers are going to need to see Tesla at least above 252.80 in order for them to get comfortable again. Anywhere between 226 to 252, Tesla is going to be very unexpected. It's going to be tough to trade. This is not really our favorite trade right now. We may consider a downside put on Tesla if it breaks 226.30, but for now we are just watching it from the sidelines. Yes, you can take some scalps, but swinging anything on Tesla right now is going to be very, very risky because it is currently in a consolidation mode. It's not in a breakout or sell-off mode for you to catch clean trades. Next stock on our watches is going to be Apple, which is the biggest mover so far this week or last week. Of course, Apple is trading right back at its 200-day moving average. This is not a good sign because Apple had just tested this point back in October and it rallied very strongly off of it. But you know what they say, elevator down and stairs up? This is exactly what's happening with Apple. It's taking the elevator down and it's doing it very quickly with very strong volume. Another thing we want to point out is that strong relative strength. Notice that Apple is nowhere near these lows, yet its RSI is way stronger on this sell-off, which means that there's a ton of relative strength in the selling side for Apple currently. So going into this week, the first thing you want to focus on for Apple is going to be the support of 178. If Apple breaks below 178, it will definitely free fall towards 173 to 174. Just because Apple seems a little oversold right now, it doesn't mean that markets will not keep selling. Remember, markets were already scared of slowing sales, and Apple's profits have been slowly declining over the last few quarters. And so the fact that it started off the year with a downgrade and a big sell-off may be spelling some big trouble for Apple in the months ahead. Of course, we will talk about future resistance and support points in our next video, so make sure you're checking back in. Now, in terms of resistance points, the first resistance in the way for Apple is going to be 183.15. Above that level, it can retest 187.40. 187.40 could be a pivotal point because you can see that there was time spent in consolidation. So Apple consolidated from November 13th all the way till about December 5th above 187.40 before it broke out. And so if it does a break above 187.40, it may help buyers gain more confidence, but nonetheless, they're going to need to see Apple back above 195.45 at least in order for them to gain full confidence. We do not expect Apple to see 195.45 this week, but if it does, make sure you're checking back in because we will for sure update you on these levels in our next video. The next stock on our watches is going to be Amazon. Now, Amazon, just like Apple, took the elevator down. Relative strength is extremely strong. MACD histogram is already reading in the red and crossing down. So overall, these are some troubling signs for Amazon and technology stocks in general to start off the year. We do see opportunity in other sides of the market. You know, Wall Street typically likes to move money from one side of the market to the other side of the market. And so as we saw technology stocks coming down, we saw the healthcare sector go up this week. In fact, we caught multiple healthcare stock trades in our group for different stocks like Moderna or XLV in this case, which is the healthcare sector. But back to Amazon, so as money is flowing out of tech, it's flowing into the other sides of the market, and there are opportunities on both the ups and the downs. For Amazon in specific, we can see that Amazon is back at its 50-day moving average. Here are some levels to focus on for Amazon. First things first, you have a resistance at 147.40. As long as it is below that level, bears and selling will be active. And that's because Amazon is back within this consolidation range here. So remember, buyers took weeks for Amazon to finally break out of this consolidation. So the fact that it couldn't hold and it's already back at it, it may discourage buyers from holding, and it may have some selling influence. So to the downside, the first support in place is going to be 142.80. If we break below that level, then our next downside target for Amazon is going to be right around 139 to 140. Resistance points in the way are 151 and 152.65. Buyers are going to need to see Amazon at least back above 152.65, right around this consolidation range for them to gain a little bit of confidence back again. Next stock on our watches is going to be AMD, which was one of the best performing stocks in 2023 or to seal off 2023. In fact, we caught a trade on AMD from 100 all the way to about 140 in our group, so a pretty awesome 40% gain. And we did exit right at 140. Yes, we missed on a 10-point jump after that, but nonetheless, we are glad we exited because we are seeing a ton of selling action on AMD currently. So for AMD, looking at its daily candles, we can see that like SPY, it is below the 10 and 20-day moving averages, and it retested the 10 and 20 and it got rejected. Therefore, we know that sellers are trying to take full control here. And if they do break below last week's lows, they will definitely take full control. So here are some levels to focus on. First things first, we have a support at 131.90. If AMD breaks below that level, it could be in trouble, but our very strong downside support is going to be 126.70. This is a point in which AMD spent weeks consolidating right below before it finally gained enough traction for a breakout, and so buyers are not going to be happy if they see 126.70 broken, and it will be a very strong free fall towards 116. Resistance point in the way is going to be 143.40. If AMD can break back above 143.40 rather, that would place it back above the 10 and 20-day moving averages. Remember what we said earlier in the video. Every single day, every single morning, you should be looking at the daily time frame and seeing where did the daily candle open in relation to the 10 and 20-day moving averages. And so if AMD is back above 143.40, it'll place it back above these two moving averages, and buyers will try to take control again and try to lead it back towards 150 to 152. The next stock on our watch list is also another semiconductor. Now, many people were surprised to see Nvidia failing last week, especially after Nancy Pelosi took a major call position throughout the year for all of 2024, but it looks like she may not have been right in terms of timing because Nvidia sold off right after. But just keep in mind, just because someone did something, it doesn't mean that they necessarily know what's going to happen. The market is filled with uncertainty. Nobody truly knows what's going to happen, not even Nancy Pelosi. So in this case, let's take a look at Nvidia on the daily time frame. Nvidia has been a very, very frustrating stock to trade, especially if you're trying to swing it, because you can see there's no consistency. The stock is kind of just moving sideways, which is happening with a lot of stocks on the market right now, especially in tech, which is why we always tell our members and our hyper team that you don't always want to focus on tech stocks. For the purposes of these videos, of course, we always focus on tech stocks because they control the majority of the market. But there are opportunities outside of tech. You have energy, you have healthcare, and you have communications. There are plenty of other sectors out there to focus on with plenty of opportunity. So if you're just focusing on tech, you may get caught in a period in which tech is moving sideways and it becomes very frustrating to trade. So for Nvidia in specific, considering it is moving sideways, you can see that there's a lot of resistance and support points for it here, but we are pointing out that Nvidia has been making lower highs and lower lows on the very short-term charts, which is something that SPY did. You can see that SPY did this right before it broke lower. So here SPY was making lower highs and lower lows before it finally completely gave up and broke lower. This is exactly what's happening with Nvidia, which makes 472.70 a very critical support. This is the lowest point that Nvidia made last week, and so if it breaks below it, it will be a very strong free fall towards 449 to 455. 449 is another major support to focus on. The last and final stock on our watch list is going to be Meta. Meta is one of the stocks like Nvidia that's been moving a little sideways. Yes, they had some strong downside movement last week, but it wasn't enough to break below the 20-day moving average. It is trading right below the 10 and right above the 20, so it's likely going to be moving sideways until some kind of catalyst moves it higher or lower. First support in place for Meta is going to be 349.60. Below that point, we don't really see much of a support until 340. 340 is a very critical pivot point. If it breaks below that level, we expect Meta to free fall towards 328. And of course, below 340, it will be below the 20-day moving average and starting to move towards the 50-day moving average. So that wraps up our review for the week. Thank you guys so much for checking in. Make sure you subscribe and like.